It's a mega crisis that happens about every 80 years. So, people kind of forget about how bad times were, so they start spending and leveraging up. I mean, I think that a big problem with these prior periods of crisis is debt. Debt gets very high. So the governments in the West are just massively over leveraged. This is really the last thing we need as a society right now, where the rich get richer, the poor get poorer.
The NASDAQ dropped on Tuesday as the tech sell-off, which started a few weeks ago, continues. Where is this headed? We're going to be talking about this and the broader theme of, I guess, more volatility in our social economic landscape, which is driving a lot of volatility in the markets, perhaps. We'll be talking about this theme with our next guest, David Hay, Co-CIO of Evergreen Gavekal, a fund that manages a diversified portfolio of more than $4 billion in assets. Welcome back to the show, David.
Thank you, David. It's great to be here. And I should point out that the reason I look a little weird here on the right side of my face is I did have Mohs surgery, as you know, on Friday, which is a skin cancer operation. And I know you've got a lot of folks that are my age, or maybe a little younger, maybe a little older, but you get into your 60s and 70s, and you really have to be careful when you get these spots that pop up, and particularly if they don't heal. So just be on alert for that, because if they catch it early, which fortunately they did in my case, it's very easy to treat. And if it's going to let to go too far, it can go to melanoma, which is bad stuff. So,
yeah.
Again, thank you for having me on. It looks like another lovely day in Vancouver, lovely summer day. The gloom is in the air. And believe it or not, I'm over here on the almost Idaho border, and
it just so happens this is like the first week of the summer we've had any rain, and I don't know, people didn't have any winter tires on or anything, and there were 2 traffic accidents because the road was slippery. Anyway, I'm glad to see that you're doing well. Glad to see that you've tended to your skin cancer early, so that's good. We're here to get your update on the markets. People can check out our conversations from earlier in the year. Links down below. David, what's happening with this great rotation that you wrote to me offline? You wrote to me there's this great rotation happening. We're certainly seeing that with the tech sector selling off, the Russell 2000 staying flat. It's rallied earlier last month. Where is this headed, do you think?
Well, I think it's for sure happening. So yes, it's not speculative, because we've been talking about this in Evergreen and the Haymaker, my newsletter, and various podcasts for quite a while, hoping that we would get a great rotation similar to what we had in 2000, 2001. Those are a lot more fun than what we had in 2022, an outright bear market. As far as is it going to continue, I think that's a function of the economy. If the economy does soft land, which that's certainly what the majority believes, either soft landing or no landing, then it probably will continue. And one of the reasons why there's so much enthusiasm for the smaller companies is because there's a view that the economy is decelerating, not going negative, but decelerating, which gives the Fed cover to start cutting interest rates. And we got a Fed meeting. What is it? That's today, right? Or is it's either today or tomorrow.
Yeah,
and I believe that they're going to do nothing but probably, talk about a September rate cut. But, if we get 1 to 2 rate cuts between now and the end of the year, or maybe even the first of next year, that's going to be probably it. And that's really not going to do a whole lot for companies that are heavily indebted. I don't think it's going to do a whole lot for the housing market, which is looking really ugly here all of a sudden. And, we could talk about housing and maybe at some point, but it's certainly defied gravity, unlike other parts of real estate, which are really coming apart at the seams, particularly commercial real estate. So it's an odd time, and there's a lot of weird stuff going on out there. And, we were talking about offline that, this theme, there's the great rotation, but there's also what I call the great disconnect, which is this divergence between really pretty scary fundamentals societally and geopolitically. I don't think I've ever seen Americans as scared as they are right now. So many people I talk to are thinking about relocating to another country, or, they're making sure that they can, survive, with, whether it's preppers or their armaments. And it's a very divided country. It's also a heavily armed country, particularly on the right. And as you and I were talking, I just tremble to think what would have happened if that shooter had been a little bit more accurate and Trump was assassinated. And then, what his very, very loyal followers would have done in the wake of that. But that's just one of many things that are fundamentally wrong with the country. We've talked many times before about what I refer to as the 4F scenario, the federal fiscal funding fiasco. And that, I mean, you probably saw this. The Congressional Budget Office just increased the deficit. We thought it was going to come in at 1.6 trillion, which was bad enough, but they pushed it up to 1.9 trillion, $400 billion increase. So we're basically going to have another year where we run a $2 trillion deficit. And that definitely tends to support the market and the economy near term. Mm-hmm. But from a long-term standpoint, it's horrible.
Yeah.
So it's just this weird clash of bad fundamentals and kind of market euphoria. Sorry.
Before we continue with the interview, I'm going to tell you about another way you can invest your Bitcoins and store them safely instead of using a traditional wallet or an exchange. Consider an IRA. Today's sponsor, iTrust Capital, is one such IRA that offers 35 crypto assets and the lowest trading fees in the crypto IRA space at 1% only. And being an IRA, it also offers unique tax benefits. If you'd like to get started and learn more, click on itrust.capital/David in the link down below or scan the QR code up here. If you're over 18 and you want to open a new account with cash or roll over an existing account, you can do so using my referral link. And if you use that referral link, you'll get $100 in signing bonuses. No, that's fine. That's a good setup. I want to come back to the Great Disconnect in just a minute. Going back to the small cap. So yeah, about a 10% rise in the NASDAQ since July. What are you thinking in terms of positioning right now? Is it too late to get in, or do you think the small caps have more room to climb? Mid caps.
Yeah, so it all depends, I guess, on entry point and where you're pulling your capital from. We actually put out a buy on small caps early November of last year, and they're up 25% or so. Now you said, well, the market is too. That's true, but the market, of course, has been almost totally driven by NVIDIA and a handful of other mega cap companies, mega cap tech mostly, and you haven't had that in the small caps. So the small caps done it kind of on its own. So I think that's a little bit more impressive. But at this point, I would suggest, and actually did, ironically, yesterday in our Making a Monday newsletter, that you should be taking some profits if you did buy small caps when they were really cheap. So I wouldn't be chasing this one. It's been such a big move. And if you look at it relative to the NASDAQ, it's like 20%. So NASDAQ's down about 10. Small caps are up about 10. I'm rounding a little bit, but it's a 20% delta. That's pretty huge, as somebody would say, that we have the orange swan.
How are you feeling about, I guess, the Fed cut that people are anticipating may happen by September? Not this week, but September. Now, what's that going to do with this rotation? Are we going to see continued rotation into, I guess, higher growth sectors if the interest rate is slightly lower, or will this not have so much impact?
I think it's pretty exaggerated, frankly. I just don't think you're going to get that many rate cuts near term. And when you do get a lot of rate cuts, which is more likely a 2025 event, that's probably going to be a response to bad economic news, that we could be looking at a recession. There are some very bright people like Danielle DiMartino Booth who believe we're already in recession, and she's got some pretty strong arguments in her favor. I read the other people that like Vincent Ward and Kevin Muir, who say, your countryman, Kevin Muir, that there's no way you can go into recession when you got $2 trillion deficits, and I'm sympathetic to that view. So it's very confusing in that regard. I could kind of go back and forth. Sometimes it looks like we are tipping into recession. Just as a footnote, we're very close to triggering the SOM rule, which is this unemployment increase. It's 3-month moving average versus the previous 12-month, 3-month moving average. If it increases a half a point, 50 basis points, then a recession happens every time. And it's right on the threshold of occurring. And of course, we've had the longest yield curve inversion. We've had I don't know how many months now of negative leading economic indicators, with 1 month that's slightly turned up before turning to the downtrend. So it's like so many things we're dealing with in our world right now, very, very confusing. But eventually we're going to have a recession, and then the Fed's going to cut like crazy. And people say, well, that's great. Well, not really. I mean, if you look historically, when the Fed has really been in a frantic rate cutting mode, markets have struggled. I mean, just look at 2000, 2003. And then over 2007 to early 2009, those were times where the Fed was cutting, very, very quickly and deeply, and basically took short-term interest rates down close to zero. And yet the market went down half. It got cut in half, both cases. So this could be the classic, be careful what you wish for. You might get it good and hard.
Yeah, the unemployment rate comes out this Friday, so we'll see what happens if the SOM rule is officially triggered. Okay, so let's talk about this 4F scenario that you've outlined here. Federal fiscal funding fiasco, still a big problem. The deficit is expected to widen. The debt level is expected to widen. This is a nonpartisan projection by the CBO. And the question is whether or not this is going to be an issue or become an issue for investors at some point. How are you reading this situation?
I think it's inevitable. And I think that the tip off is going to be the bond market. And perhaps a good example of that is what happened with Liz Truss in the UK 2 years ago when she tried to do a very, call it Trump-like budget, and the bond market just went into free fall. And I think that is a challenge we've got is both of the two presidential candidates have shown absolutely no interest in any kind of fiscal rectitude. And I think especially Donald Trump is likely to really slam the pedal to the metal especially if he feels like there's a recession, and he could, of course, blame it on the prior administration. And that could happen. I mean, we could be looking at quasi-recession, maybe full-blown recession by the time the election happens. Maybe not. I mean, as I said earlier, it's very hard to determine that conclusively. Always is. But if it happens, I think the fiscal response from either fiscal and monetary response from either party is likely to be extremely dangerous for the bond market, particularly the long end of the bond market. And the long end of the bond market is already struggling. There's the Treasury is issuing at the short end. In fact, they were just criticized by a couple. Maybe saw that paper in Roll Rubini, and I forget who the other guy is that is accusing basically the Fed of gaming the bond market. I think they're just kind of doing a stealth Operation Twist where they try to keep the long rates down and issue so much on the short end that the short rates stay high. So that's one reason why we got this tremendous and long-lasting yield curve inversion. And it's just at some point, I think the bond market's going to say no loss. The bond vigilantes rode a bit last year. In the third quarter, I think they're going to saddle up again. And you're going to see real stress in the bond market at the long end. Short end, there's huge amounts of demand. So they'll probably continue to skew very much towards the short end for new issuance. But you think about these $2 trillion deficits, and then all that has to be rolled over, it's something like $10 trillion in total needs to be raised between those bonds that are maturing and then the additional debt over the next year. It's just a staggering sum. And you've got foreign central banks that, as you know, are net sellers of U.S. Treasuries. The Fed is still a net seller through quantitative tightening. So you got two former huge buyers that are now sellers. So it puts a tremendous amount of pressure on retail investment banks are really not buyers of longer treasuries either because they got so crushed with their longer treasury bonds. That's why 3 big bank failures happened last year. So I think that's off the radar of most people right now is another bond market convulsion similar to what we had in the third quarter of last year.
Here's my question. So you have, the Federal Reserve is St. Louis Fed data here I'll put on the screen, $1.1 trillion of interest payments from federal debt. Now, a lot of people are saying this is a problem. This is roughly 33% of tax receipts federally, 3.3 trillion or something like just over 3 trillion. My question is where this interest payment is going, because presumably we have a lot of domestic debt holders, mutual funds, pension funds, hedge funds, as well as municipalities. The Fed holds a lot of this debt. And so it's just interest payment that the federal government is paying to other domestic U.S. actors, right? So my perspective is not that bad. The foreign holders have a lot of it, of course, China, but I don't even know if that's the majority. Do you have any insight on this?
Well, I think total foreign ownership of U.S. Treasuries is around $7 trillion. I could be wrong about it, but they still own a lot. It's just that the trend has been down.
Yeah.
The only countries where you're seeing aggressive buying of treasuries are those like Luxembourg, which are basically conduits for hedge funds. Mm-hmm. So, yeah, I think you're bringing up a great point. Is where is that going? And there is a school of thought that interest, called $1 trillion of interest payment, is stimulative, and I think to a certain extent it is, but it's stimulative to a very limited percentage of the population. And so it's this tale of two situation. And I think we've talked about before. You got a tale of two consumers and a tale of two corporations. So if you're a wealthy consumer or a cash-rich corporation, these high interest rates are manna from heaven. So that's very good. Now, but the trouble is those entities tend not to be big spenders, so that they tend to just reinvest, and that could be one reason why there's been this persistent bid under the stock market, with this this interest rate windfall being recycled into other financial assets. Whereas if you're lower income or you're a more leveraged corporation, these higher interest rates are disastrous. As you know, there's over $1 trillion of credit card debt. And that's at a rate of, I think, 23%. It was the last I saw. It's a usurious interest rate on credit card debt. So it's, the classic case. And really the last thing we need is a society right now where the rich get richer, the poor get poorer.
You said that there is a risk, or the rising deficit raises the risk of a bond market riot come November. What does that mean?
Well, I think it's probably more of a riot if Trump wins, given his history. And I mean, things like already openly discussing whether they want to try to encourage the Fed to be easier. There's even rumors that he won't reappoint Jay Powell. I don't think he would try to replace him before his term is up, which I think is early 2026. But, if you remember when Trump was in there the first time, he was putting enormous pressure on Powell and the Fed. He wanted to see negative interest rates like they had in Europe. And fortunately, Powell resisted that. Although
what would have that done to the bond markets if we had negative interest rates, hypothetically?
Well, at that time, going back to 2018 or so, probably bonds would have gone even higher for a while, which would have made the ultimate bear market even worse. And that's hard to believe. It's been a disastrous bear market for bonds since the summer of 2020. So it's just like any other asset. When you get it bid up to an outrageous amount, or outrageous valuation level, then the ultimate correction is that much more vicious. And you've seen some of these European bonds, like what's that Austrian bond that was due in 100 years? I think it's down 60 or 70% in price. But anyway, the point is, at this juncture, what would happen if there's pressure to have a really easy monetary policy at the same time that there is already tremendous, forgetting more fiscal stimulus, just where we are right now is unprecedented. As you know, running deficits as a percentage of GDP, it's around 7%. That's what you typically do in a depression or a war. And we're doing it when unemployment's close to the lowest it's ever been. It's just remarkable. And I think it's remarkably reckless. So if we're going to get more fiscal stim and then there's going to be monetary easing on top of it, particularly if it's aggressive monetary easing that's encouraged or forced by Trump, that's not what bonds like. So if you got the 10-year up at a 6%, which could happen under those circumstances, that would be, I think, very deleterious, not just for bonds, that's automatic, but for the stock market as well.
Yeah, the U.S. 10-year is now at 4.147%. It's down from the highs of 4.7 earlier in April. So it just seems to be on a 3-month downturn.
And we actually did say we thought there was going to be a rally in the longer term part of the treasury market, mostly because we saw the economic data trending down. And I think that's the phase that we're in right now. This is what Jeff Gundlach calls the Pavlovian bond rally, that when you get weak economic data, particularly if it's recession, we could see the 10-year, go to 3 or 3.5, briefly. But boy, I would trade that and get out of that, because you can't sustain that situation. Just imagine where the deficit goes in the next recession. If we're already at $2 trillion, does it go to 4? Does it go to 6? Somewhere in that vicinity. And at some point, the bond market just says no loss. It can't handle that supply, and so you get interest rates up at a high level on the long-term part of the bond market. And I just don't think that most investors are factoring that in as a risk.
You're long bonds right now? The long end of the curve, at least?
No, we haven't done that. We did extend duration more, kind of long intermediate, kind of the belly of the curve. It would have been a heroic move to go with long treasuries, a few months ago, but we did extend duration, but in kind of a chicken way. We just don't trust that long end of the bond market, so it's a pretty dangerous game to play. But you could keep rallying.
Isn't a deficit stimulative for risk assets like stocks?
Sure has been. I think that's why the market, and it's one of the reasons the market has been as strong as it has. I think the other is, that we've had a strong jobs market, and you got a lot of people that contribute every single, certainly at least a month, into a 401k. And so you have these persistent inflows that just mindlessly go into index funds. And so it's great. And now what's going to happen is, if in the next recession, when there's a bunch of layoffs, do those flows turn negative, which would be kind of shocking. Then you got the baby boomers that are aging anyway and starting to retire and die off. And so at some point, that great money generating machine that has been the retirement plans of America collectively is going to run in reverse. And I think that's got negative implications. So that's a longer term issue. I think that near term, there's other threats that are likely to rise before that. And the one that we've seen here lately is just simply overvaluation. And there's tremendous focus on the Magnificent Seven and how pricey they got. It's certainly NVIDIA got expensive. We got lucky and put out take profits on that in early July. But in general, where the really nutty valuations are, kind of the next level down is, I think you and I've talked about before, I call them the COPs, the crazy overpriced stocks. But just look at CrowdStrike, which of course is all over the news right now because of their outage, but it got to 600 times earnings. That's been almost cut in half, so it's down to a little over 300 times, but it's 300 times earnings. Or look at a Carvana, which is one of the hottest stocks, favorite stocks in the memers, the meme crowd. And it's trading at, like 500 times earnings, based on earnings 2 years out, because they're actually still losing money. And there's just just look at investors daily, business daily, and see, I'm sorry, it's not daily, it's weekly now, and just see how many companies are trading at these outrageous PEs, 100 plus that you've never even heard of. And those are the ones that got annihilated in 2022. They're starting to get annihilated again. I think that's where the real pain trade's going to be.
Well, how do you feel about the Mag 7 and the S&P 500 right now? I don't want to put them in the same category, but it certainly looks like they've been in the same category. So we've talked about bonds, your outlook for risk assets.
Well, when you say Magnificent Seven, I think you can't tar with the same brush. I sent you all these charts of companies that are breaking out.
Yeah.
And that aren't too extended from the breakouts. And Google's on there, Amazon's on there, and they're in the Magnificent Seven. I think those look pretty good. I mean, Amazon's definitely on the spendy side, but you got to look at it relative to the growth rate, and on a price, the PEG, price earnings growth, it's not too bad. Google's kind of been our favorite in the Mag 7 area, along with Microsoft, and Microsoft's more expensive than Google, so I kind of lean toward Google at this point if you're looking for a Magnificent Seven exposure. But I think there's better places to be for the most part. And like I said, small caps are on a lot right now, so I'd actually be taking some chips off that table. But mid caps look really interesting. They have been. I think they broke out. It's kind of sometimes the breakouts you have to wait until they're decisive. This one's a little speculative to say that it's a clear breakout right now. The mid caps have been lagging. They're trading at a mid-teens PE. So I think that's a pretty good place to put money. The dividend aristocrat types of names, which had also been lagging badly for 10 years. But if you go back 20, 30, 40, 50 years, they've consistently beaten the S&P. So they've got a lot of catching up to do, and they're breaking out. That's a beautiful chart. Or like on the dividend, on the Vanguard Dividend Appreciation Index, or the Vanguard High Yield Dividend ETF. So there are definitely places to be putting money. And as I mentioned to you before we started recording, what's impressive about looking at all these breakouts, and I've looked at like 150 and then kind of narrowed it down and to the ones we like best, which is about 60, and how many of those are financials, and not just in the US, but around the world. And that's financial stocks tend to be a leading indicator for the market. So I think if you want a bullish, something bullish to hang your hat on, that's a pretty good one.
Yes.
So it's, I said, people kind of say, oh, you're so bearish. And I said, well, I'm bullish on a lot of stuff, but I'm bearish on certain things. And I keep coming back to these stocks where you just go, does it make sense to pay 600 times earnings for CrowdStrike? And it had a lot of momentum behind it. And Jim Cramer was always pounding the table on CrowdStrike. But if something goes wrong, which it obviously did with CrowdStrike, and you're in a stock that's at 600 times earnings, you're just going to get annihilated. Whereas if you buy a company like Ryanair, which has been one of my disappointments lately, and it's, it was 10 times earnings. You just don't get hit nearly as hard with that kind of a valuation. So it's, I think we're in a situation where maybe we're rotating, again, getting back to this great rotation theme, toward more reasonably priced companies. They're still really good companies. Ryanair is a great company. I mean, it's one thing to pay a cheap price for a crummy company, but if you can pay a cheaper, reasonable price for a really good company, I think that's how you make money in the long run. And you avoid these utter disasters.
I just wonder if the big tech companies, the Mag 7, are good valuation in terms of from a P to growth ratio perspective. If you were to evaluate the growth over the next 5 to 10 years or beyond, would you say that the growth that they've experienced in the last 10 years can be extrapolated forward?
Great question. I think that's the hardest part, especially like with an Amazon. Probably not. I think it's going to grow slower, but even if you use a slower growth rate, more like 30% growth rate, still a lot. It's about a 1.5 PEG, so price to earnings growth. That's about what it is with Google, Alphabet. I prefer Google. And that's, just kind of projecting a continued 20% type of growth rate, which what's interesting about with them, they've been able to do it with both top line and bottom line. Where I get a little squirrely, and I think anybody should, is where a company, let's say, had 20% earnings growth over the long run, but only 10% sales growth. At some point, I mean, that's obviously being driven by expanding margins. Hard to keep sustaining that. Now, having said that stuff, I think one of the negatives for that group is that there's an awful lot of options involved, where they issue a lot of options to their employees, and they don't count that as an expense. So you could argue that tech earnings are overstated. And that was a big argument in the early 2000s when the first tech bubble burst. I think that's going to come up again. And I've just been around this long enough to see where tech goes through these periods where it's, like invincible. And then it goes into other periods where nobody wants to touch it with a barge pole.
Fair enough. So let's rotate, pun intended, let's rotate to commodities now. Oil has had, I have moments of brilliance, and then the rest is just me. Rotating out of stocks. So the WTI crude, Brent, I'm looking at the screen right now, $75 a barrel. It's down from 85 just a couple weeks ago. Now, this volatility is nothing new to oil. It's been going up and down all year, but I just wonder if this this downtrend over the last couple of weeks is indicative of something bigger.
Well, it could be that it's because of this growth slowdown that seems to be better perceived, or I used to call it the 3 Rs, the rising recession risk scenario. And oil is perceived to be, and it is economically sensitive. Somewhat, not very much. I mean, if you look historically, it actually tends to do pretty well. Once you get into a recession, it tends to come down. Like most commodities, actually, most commodities go down before the recession starts and actually rally through the recession, opposite of what people think. But I really think what's going on with oil more than we put out because I definitely get painted as a perma bull on oil, but we did put out a recommendation to take profits to cut down the positions. In fact, I sold all of my personal oil futures contracts in June. My main reason for doing so was it looked to me like the Biden administration was and still is positioning to do another SPR release, Strategic Petroleum Reserve release, for political reasons. And now that we have kind of more of a horse race going, I think the tendency to do that is even stronger. And one of the reasons why I suspected that was because of the IEA, the International Energy Agency, which is the biggest authorities, for bad reasons, frankly. They don't deserve that kind of credibility on the energy market, the oil market specifically. And they put out a report here saying that in the second quarter and the third quarter, demand was going to be much greater than supply. And usually they're the other way around. They chronically underestimated demand and they've overestimated supply. So that was really odd. And it looked like they were trying to create cover for another SPR release. Now, that's kind of conspiracy theory stuff, but the Biden administration has been dropping hints in the press. And this is where I think they can kind of game the system without actually doing anything. They just drop enough hints in the media, then the futures traders say, we have limited upside and quite a bit of downside if we short the futures contract. And the thing about oil is the futures contracts are about 50 times in volume size relative to the physical market, whereas most commodities, it's 3 to 5 times. So what's happening with those derivative plays on oil have so much more impact on what the real world is. Because if you look, oil demand is still very strong around the world. That's despite the slowing in China. There's a big backwardation. That's the difference between the near-term market and the long-term. Usually that's the other way around. That's why it's called backwardation. It's backwards from normal. That's usually indicative of a supply-constrained market. And if you look at inventories adjusted for all these SPR releases that have already happened, inventories are unbelievably low. So it's a very, very strange situation. But that's why I reduced my oil exposure. And I think we're getting up to the point where we're going to get a great rally. And there was also too much bullishness, frankly, in the hedge fund community a month or two ago on oil. And now that's slipping to very bearish. When you get very bearish among the speculators, that's when you get the big rallies. So I think it's setting up for another one of its great up moves that it's had many of in the last few years.
The U.S. Department of Energy said on Monday, reading a Reuters article, it had finalized a contract to purchase 4.65 million barrels of crude oil for the Strategic Petroleum Reserve for delivery. Now, this is, it's just a drop in the bucket for the overall, compared to the overall levels. But there's speculation that they're trying to replenish that. Are you seeing any evidence of that speculation playing out?
Well, they should, and they did a little bit earlier, but then they made that they made that release of gasoline in the Northeast here a month or so ago, and that was a relatively small release. But I mean, there is a school of thought that because the U.S. is now such a large producer of oil and gas, that we don't need to have an SPR, or at least as big an SPR as we did before. So they could make that argument, but it's down so much. I don't know. I think there's one more big release coming, and then that's probably it. And that's why I think once that's announced, that'll just kind of flush things out and set the stage for the rally.
How do you feel about precious metals? Let's talk about gold now. Gold was at $2,400 not too long ago. It's come down a bit from its highs just a few weeks ago, and it's now hovering around. Well, it was at it went up today. Anyway, it's at 24.53. And this is just it's had a great quarter, but it's been range bound. And I wonder if, going back to what we talked about earlier, your outlook for a recession, your outlook for not so many rate cuts, how does this all play into the dynamics for gold?
So gold had a big breakout. I think it was early this year, late last year, when it broke decisively above 2,000, because that had been the resistance. And you're right, since it had that big breakout and sprinted, 20% very quickly, it's been kind of digesting that big move, which is not surprising. That's often what happens. Where will it go from here? I think, the pullbacks will be like they have been, relatively shallow. And I think we're positioning for another major up leg, particularly if there has to be some kind of clever maneuver to try to get out of our the 4F scenario that we talked about earlier. And there's a guy who I think you might know, Luke Groman, the Forest for the Trees, who I track very closely. And he has a very interesting thesis of how they're going to do this, which is to have a massive revaluation of gold, like to 10,000 or 20,000 an ounce. So the U.S. holds a lot of gold, but relative to its debt levels, it's actually very low because the debt's grown so rapidly. So if you revalue gold up, and then they could actually credit that to the Treasury's checking account, the Treasury could then use that to buy back a tremendous amount of long-term bonds, trillions of dollars of long-term bonds, which would both stabilize or as he says, anesthetize the long end of the bond market and allow the U.S. to deleverage. Now, it would have, you would think, fairly significant inflationary implications, but I really think, David, that the only way that a lot of these Western governments get out of this mess they're in is with inflation. They've got to inflate away the debt. They did that after World War II. And I think we're going to do that again. I did hear Peter Schiff recently say, well, they also were running big surpluses after World War II. So they were paying down debt as well as using a surge of inflation. And that's true. That was valid. But if you look at the 1970s, for example, there were no surpluses. There was only deficits. And they got the debt to GDP down. And it was only 30% at the end of the 70s. And now we have 30% with a one in front of it, 130%. And the way they got that debt down drastically over the 10 years was with inflation. So we've done it before, and we're in a much greater problem today, a much greater fix today than we were back then. So that's why I think that in general, you want to buy inflation beneficiaries on weakness, and particularly if you think about what happens in the next recession, that the policy response, both fiscal and monetary, is likely to be so inflationary in the next recession that I think things like gold or silver, which has got a strong demand from solar. Silver has corrected kind of hard here lately, but had a big breakout as well. Palladium, I think, is a great play on the hybrid surge because hybrids use a lot more palladium than do either EVs, which basically use none, or internal combustion engine cars. So there's a number of what copper has been crushed here lately, and that's a great way to play the great green energy transition or making the grid more robust, which the U.S. grid is really fragile. I think looking for plays on the grid, like strengthening or one of the better investment themes out there.
I want to close off on the great disconnect that you brought up at the beginning of the interview. So you were telling me how there was a growing risk of civil unrest. People have been looking up civil war. Even prominent investors like Ray Dalio have been talking about the significantly higher chance of a civil war breaking out. I think he placed it at 30-something% last time I checked. He wrote about this in Time magazine. You also told me that there's a growing risk that the U.S. may go into a stealth default. So all this to say that is that we're seeing more evidence, according to your notes to me. You're seeing more evidence of a fourth turning happening right now. What is the fourth turning? You're referencing Neil Howe, I'm presuming.
Yes, Neil Howe, the famous demographer and historian, and I know Ray Dalio believes that. A lot of the really brilliant macro people I track believe we are in the fourth turning. Grant Williams, for example. So I'm there. I'm with them. I think that the evidence that we see on a daily basis is just irrefutable. And so what is a fourth turning? It's a mega crisis that happens about every 80 years. So the reason for the fourth is if you divide 80 by 4, that's about 20-year intervals or seasons, if you will, that we go through. And so if you look at the history of this country, let's assume that this is the fourth turning now, and then it would actually be the third fourth turning. The second one, going back in time, was the Great Depression, World War II, go back before that, and that would have been the Civil War, go back before that, was the Revolutionary War. So actually, this would be the fourth turning. And he even goes back because we were part of the Great Britain in the 1600s. There was the Glorious Revolution in the 1600s. So they happen, and even in ancient times, so they tend to happen about every 80 years. And then you go into Renaissance period. So like after World War II, we had the American High that lasted from about 1945 to about 1965, and then things kind of gradually deteriorate from there. And people kind of forget about how bad times were, so they start spending and leveraging up. I mean, I think that a big problem with these prior periods of crisis is debt. Debt gets very high, and when you have very high debt levels, then accidents happen. I think the good news in the United States is if you look at most consumers, not too heavily indebted, most corporations not too heavily indebted. There's certainly counterexamples, exceptions to that, but it's the governments. The governments in the West are just massively over leveraged, and the government bond markets are the most important in the world. So if there's trouble there, I think it's naive to think it's not going to spread out and pan out to the other parts of the financial markets.
Right. And how concerned are you about, I guess, this stealth default? What how's that play out?
Well, I guess I'm concerned about a lot of things. That one probably not so much, because I think it's inevitable, and I think you just have to plan accordingly. So that's where, if you have a lot of hard assets, that type of thing, because the stealth default is really just using inflation to default. So the federal government will not default in nominal terms. If you buy a $10,000 T-note to do in 10 years, you'll get your $10,000 back. But in real terms, it might only be worth $5,000. That's a stealth default. That's what's been happening. So just look at the losses that long-term government bondholders have had since the summer of 2020. They've been staggering. And that's why some of these banks, really, if you looked at most banks and you marked them to market, according to Chris Whalen, who knows more about bank balance sheets than anybody I know, that if you marked them, almost every bank in the country would be broke based upon where their government bonds are trading, and their corporate bonds, and then of course their real estate book.
Yeah, and they're not realized losses yet, though, right? So they're just these are
no, but that's what's interesting. Where they get realized in a hurry is when they get bank runs, because then they're forced to sell these things. And there was a big Japanese bank that just sold $60 billion of treasuries and took a huge loss. And as far as I know, that bank didn't fail. There was one recent, fairly small Republic First, I think, bank failure in the U.S. I think there's going to be more bank failures too, and I think that's going to trigger a more focus on some of the risks that are out there. And so it's a precarious situation. I think it's hard to deny that. Now, are there opportunities? Absolutely, there are. And like I said, I think it's very encouraging, and I have a little bit of a hard time explaining. Maybe it's just that we're really starting to factor in all these rate increases or decreases. That are coming, why the financial stocks are acting so well, because they do tend to like lower interest rates once they've gone up high, and a steeper yield curve. I think that's what's going to happen. That could be, maybe that's what that market's starting to snip out. Much lower short rates, long rates staying about where they are, maybe even going higher, and that kind of a steep yield curve is really good for financials.
And ultimately, this stealth civil war you mentioned, what does that look like?
Well, I hope it's the stealth part of it. But like I said, we are heavily armed, particularly on the right. And I think the right is getting they're very cognizant that there's been this, what I call kind of this natural gaslighting that's been going on, particularly since COVID. And just look at and I'm a centrist. I really, as you may know, I was a big supporter of no labels and their attempt to have a bipartisan ticket. I was hoping it was going to be, say, Nikki Haley and Joe Manchin. I kept warning people, and our whole group did, that, do you really want a rematch of Trump Biden? I don't think a Trump Harris is a great choice either. But I think that the right is very worried. They feel like they've been victimized, and that's never a great mentality. So it's a volatile situation. There was some, I forget her name, but some expert, I think Grant Williams was quoted on how if you check off the boxes of countries that have civil war, U.S. basically checks all the boxes. Now, I'm optimistic enough to think it's going to be more like what we had in 2020, the Black Lives Matter and all the civil unrest, and that it doesn't really come down to where, the military has to decide what part of the country they're going to side with. And as long as the U.S. military is powerful and independent, then we're fine. But if what I do worry is about states, certain states that are saying, "Look, we're fine." Let's say it's Texas or Florida, so we're fine. You guys are broke, and we're going our own way. And got Texas National Guard, and start getting that kind of a situation. And I'm not saying it's going to happen, but that would be my nightmare scenario.
Yeah, states breaking off. Yeah, I've heard that before too. Okay.
Well, and even if they don't actually break off, but they just say, "Look, we're running our own show here. We're not going to secede." And I think that would be a secession is really a bridge too far. And I don't think it's going to come to that. But I think there are things that are worrisome enough even before that.
Finally, I want to close off on the Bank of Japan. So there's, by the way, major announcements this week from central banks. We've got the Fed, Bank of England as well. The Bank of Japan has been suspected to been propping up the yen through intervention, something like 6 trillion yen they've spent. It's been reported. And the yen has been really appreciating from its 38-year low against the dollar. So does this have any impact on U.S. markets? The yen carry trade, suppose it reverses. Will this have any impact on treasuries, for example?
Right. So just so people know what you're talking about, the carry trade is where either domestic savers in Japan borrow at very low rates. Apparently, Warren Buffett has done this to actually goose his returns with his Japanese holdings. But a lot of hedge funds can borrow at virtually nothing in Japan, and they're borrowing in yen. So if they have a very low interest rate and then they earn money higher rates overseas, which is easy to do, and then the yen goes down, it's like they went all the way around. But then when it reverses and the yen starts to rally, that's when it starts to get painful. And at this point, I think it's been a relatively minor degree of pain because it's basically just profits that have been foregone in this rally that the yen has had. I think it's up 6% from the low, which for currency is a lot in a short time, but it was way, way down, and it's still deeply undervalued, particularly versus the U.S. dollar. If you look at the Big Mac index, which compares the Big Mac in, say, Tokyo versus New York, the yen is still like 45% cheaper than the dollar. So the question is, has it been behind some of this weakness in tech? I think so. I think that could be that, even Japanese investors have been buying U.S. tech, and if they're deciding to repatriate and bring money home to Japan and sell their U.S. tech stocks, that could be creating some of this negativity we've seen on tech all of a sudden. But it's another one of these potential things. It's so big. The carry trade is so big, and it went on for so long. And the yen. And I would also say that if you look at Trump, he really believes the U.S. dollar is way too expensive. He wants to get it down a lot. Some people think he can't. I think he can. So I think the yen is one of the best ways to hedge a much lower U.S. dollar, which I think ultimately is coming.
Interesting. So you'd be long yen right now at current levels?
I am at long yen. Mm-hmm.
Okay, very good.
That's moved a lot in a short time, so I'd be a little careful about getting into it right now. Although I think you could nibble a little bit at this point, even with the rally it's had. It's just fantastic. I mean, people should really, if they want a cheap vacation, go to Japan. It's true. Prices are just unbelievable.
Yeah. That is a fair point. Okay, let's close off here. I do want to talk about the dollar in more detail next time. We didn't have much time to talk about the dollar today, but you're right. Trump and his running mate JD Vance, they want a much weaker dollar. We'll talk about that. Good to have you back, David, and good to see you still doing and still in relatively good health. And I hope for a speedy recovery. And I hope to see you again soon.
That'd be great.
Okay, and thank you for watching. Don't forget to like and subscribe.